Hello there, this is Hector. Welcome to my Forex trading course. Over the following chapters and the following videos, I'm going to be explaining in detail my trading system, okay? All the different tools and trading strategies I use in order to, well, trade for a living full time, and how you can also absorb and adapt those techniques, those strategies into your own trading. Okay, I don't want to get ahead of myself. In this first chapter, I only going to be talking about how to spot valid trading opportunities, how to seize those opportunities, and filter out the high probability trades, the high probability setups, and discard all the rest. Okay, in this first video, I'm going to be laying out in detail how I personally spot trending scenarios, okay, how I spot the trend, how I qualify the trend. You know, different traders use different techniques. Some of them use the ADX indicator. Some others use actual trend lines. I myself prefer to rely on actual moving averages. And the reason as of why I prefer moving averages over trend lines is because trend lines usually leave too many loose ends. For example, in this chart you are seeing right now on my live screen, which as you can see is the American dollar against the Canadian dollar on the 4 hours time frame. You can always draw a number of trend lines in your chart. Clearly the trend starts here, and well, we can firstly draw that trend line, that first trend line. As we can see, it gets breached there and then there, so therefore we can draw yet another new trend line, which, well, it holds in place there, and then it's retested and holds once again there, but then it gets breached there. Okay, so you may be thinking, all right, this trend is finished, now we are heading up. But well, as you can see, we are actually afterwards, well, price continues to go down. Therefore, we can draw yet another third trend line, okay, right there, which once again, well, it holds price there, and finally there, but then it gets breached there once again, and it seems like it's standing around yet again. So that's my problem with trend lines. There are too many loose ends, too many possible readings on that trend, and I usually find moving averages to be more reliable, okay, more stable as per where the trend is going. Okay, I use three moving averages as far as spotting the trend. That's the 30 simple moving average of the close, the 50 simple moving average of the close, and the 100 simple moving average of the close. Okay, I usually plot the 30 in green, then the 50 in red, and the 100 in blue. Okay. Now, once I have those three moving averages plotted on my chart, I search for 6 particular conditions to apply, okay, to be in place, all of them at the same time, before I can safely label a trend as, let's say, healthy or stable. Okay, now I'm gonna be listing all those 6 conditions to you, and I'm gonna be explaining the logic behind. Okay. All right, the first condition is that all the 3 simple moving averages are in order. Okay, as you can see, in this case we have the 30 moving average below the 50 and the 50 below the 100. Okay, that means that the first condition is fulfilled, and therefore we are possibly, if all the other conditions apply, we are possibly looking into solid downtrend. Okay. Moreover, the second condition is that all the moving averages are pointing in the same direction. Okay, as we can see, all the different moving averages, the 30, the 50, and the 100, they are all pointing down in the same direction. Okay, we don't have, I mean, we could have the 30, the 50, and the 100 all in order, but the 30 already curling up and beginning to point up. Okay, that would mean that this trend is weakening, is endangered, or at least for the time being, is not as strong as I would like it to be. Okay, in order to search for. all right, on those moving averages, they are all of them parallel to each other, or like I say, no crossover whatsoever. Always the 30 moving average remains below the 50, and the 50 always below the 100, always parallel to each other, always pointing in the same direction, and no crossover whatsoever. So far so good. We are certainly, for the time being, we are certainly downtrending. Now, the fourth condition is that price remains on the right side of the 50 simple moving average most of the time, okay? Remember that the 50 simple moving average is the one in red, and what I like to see is price on the right side of the 50. That means that if we are looking into a downtrend, I like price to remain below the 50 simple moving average most of the time, okay, and it's been so. I mean, it's been below the 50 for quite a while. A little pierce above is okay, as long as it dives back down immediately. At the end of the day, the markets are not perfect, okay? The markets, you cannot expect price to behave the way we like it to behave all the time. So in a trend, sometimes on a pullback, okay, we might see price breaching above the 50 for just 1-2 bars, and immediately after diving back down. Like I say, as long as that breach above doesn't take more than 1-2-3 bars maximum. Within 1-2 or 3 bars, price dives back down into the right side of the 50 simple moving average. We can safely say that the trend is still in place. All right. Basically what we want is the 50 simple moving average holding price on the right end of the trend, meaning below, in this case, since we are in a downtrend, below the 50. Now, the fifth condition is that the 100 simple moving average has never been breached. Okay, in my opinion, this is an important condition. I want the 100 moving average to never been touched, okay, never been violated, and price being nowhere near it, in fact, okay. Just as I said that as I said before, then it's okay to have a quick touch above the 50, as long as price dives back down immediately after. I like price to be nowhere near the 100, okay. Any single touch, even if it's just for 1 bar, I consider the trend to be jeopardized. And the reason for that is that, well, we all know that as price trends in one direction, we go through 2 different stages. Okay, one is the thrust, the swing in the direction of the trend, and then we usually see a little bit of a pullback, then another thrust, then another pullback, another thrust, pullback, okay. Most of the trends are shaped up in that way, okay. A swing in the direction of the trend, a little bit of a pullback, which is never as long as the previous swing in the direction of the moving averages. Then after the pullback, once the pullback has been finished, we take off yet in another swing in the direction of the moving averages, then yet another pullback, which is never quite as long as the actual previous swing, okay, never quite as long, and then another swing, etc., etc. Well, in this trend, as I was just showing you guys, well, we basically go through swing, pullback, swing, pullback, swing, pullbacks, and so on. In order to, in most of the trends, in order for price to touch the 100, usually what we see is quite a large pullback. Okay, let's assume, for example, this last swing I'm marking right now in my screen, and it's followed by this pullback. If we were to reach the 50, the impulse part of the swing to be much larger than the retracement part, okay. You have a nice long thrust in the direction of the trend, and yeah, a small pullbacks are all right. If we were to reach the 100, as you can see, the pullback would have been way too deep, okay. The pullback would take quite a long bite, quite a deep bite into the trend, and that usually is a signal, an early indication that the trend is actually weakening down. Okay. So that's why the fifth condition of my system, as far as spotting trends, healthy trends, I mean, is that the price is never gets never around the 100 moving averages. Okay, so far we have all of them pointing in the same direction, all of them parallel, no crossover, all the moving averages in order, price remaining on the right side of the 50, and nowhere, even if it's just for 1 second, we might breach a little bit above the 50, but never to the point to get around the in the nearabouts of the 100. Okay. And finally, the last condition, the sixth condition, is that price swings harmonically off the area between the 30 and the 50 simple moving average. All right, that's what I call myself the dynamic area of support and resistance. Well, in this case, resistance, since we are in the downtrend. Okay, I usually mark the area between the 30 and the 50 simple moving average as a dynamic area of resistance. I like all the swings to take off around from this area. Okay, I like the for example, price retraces back to this area. This dynamic area of resistance holds the price below, and from there a whole new swing takes off in the direction of the trend. Okay, then sure, we may have another pullback, but I like to see once again the moving averages, the 30 and the 50 simple moving average, or rather the area in between, the dynamic area of resistance, to hold the price below, to indeed work as resistance, and from there price to take yet another swing in the direction of the trend. Okay, then another pullback, price reaches the dynamic area of resistance, and bang, another swing in the direction of the trend. Okay, and so on and so forth. Once price in fact breaks above the dynamic area of resistance, once the dynamic area of resistance actually does not work as resistance or stops working as resistance, price breaches above the 50 simple moving average and gets near the 100, that's an early signal of weakness. Okay, I'm gonna be showing you now some examples, clear examples as of why I consider the area between the 30 and the 50 to be a dynamic area of resistance. But just to dip you guys into this concept, I like price, all the different swings, okay, all the different retracements to end at this precise junction of the chart, and moreover, most of the different swings to be created of that area. All right. Now, I'd like to stress the point that these 6 conditions are universal across the across any time frame and across any currency pair. Okay, when these 6 conditions apply, you can rest assured you are looking into a healthy trending scenario, no matter whether you are an intraday trader, a long-term trader, whether you like to trade the euro, whether you like to trade exotic crosses. Like I said, it's a universal principle. Okay, now I'm going to be showing you different examples of different currency pairs on different time frames, and you will see how these principles, all these conditions apply equally to all of them. Okay, and once they apply for possible trading opportunities of the hourly time frame or the 30 minutes time frame. Okay, let me show you another chart. That's the USD against the CHF, the Swiss franc on the 30 minutes time frame. Okay, it's one of the favorite time frames for intraday traders. Okay, as you can see, the moving averages are also fulfilling the 6 conditions I was mentioning before. They are all in order. They are all pointing in the same direction, meaning down. All of them remain more or less parallel to each other, okay? There's basically no crossover between the moving averages. Moreover, price is spending most of the time on the right side of the 50 simple moving average. We have a quick breach above, but like I say, within 1-2 bars, price immediately dives back down, okay? Price has never been anywhere near the 100, okay? This is the 100 moving average, the one in blue, and as you can see, price has never been anywhere close around them, and well, it's never been touched, the 100 I mean, and moreover, price is swinging harmonically off the dynamic area of resistance, okay? Resistance in this case is we're in a downtrend. So, as you can see, we have a swing down, retracement, the moving averages catch up with price, they do indeed work as resistance, and they push price down yet into another swing. Then we have another retracement back up, the dynamic area once again holds the retracement, bang, another swing to the downside, okay? And therefore I can, as far as my system goes, I can safely label this currency pair on this particular time frame as a perfect trending scenario, okay? This is a solid, a healthy downtrend, and therefore this is in a scenario I like to search for short opportunities. All right, I don't want to get into how I go about finding my entry signals, my money management rules, my profit takens, my stop loss placement, etc, etc, etc. I will lay out all that in detail in future chapters. For the time being, I just want you guys to remember that once those 6 conditions apply, once the dynamic area of support and resistance is indeed holding price on the right side of the trend, short opportunities in this case, as we're in a downtrend, are high probability trades. Now let's assume you are in scalper, you like to trade the very short time frames, such as the 5-minute chart, the 15-minute chart, and well, you always trade from an intraday perspective, but moreover, quick positions in and out real quickly within 5-10 minutes in order to squeeze 10-20 pips out of a move, okay? Now let me show you a 5-minute chart. In this case is the euro against the Japanese yen. Okay, like I said, on the 5-minute time frame, and well, we can clearly see how the moving averages are plotting as I like them to be, all of them pointing in the same direction, all of them in order, the 30 above the 50 and the 50 above the 100. They are all parallel to each other. There has not been any crossover for quite a while. As you can see, the 30 has always been above the 50 and the 50 always above the 100. Price nowhere near the 100, which is the one in blue, nowhere near the 100 for quite a while as well. Price spending most of the time, in fact, well, all the time really, above the 50. Price harmonically swinging off the dynamic area of support in this case, since we're in an uptrend. So basically what we see is the dynamic area holding price above, and as long as it does so in this uptrend, we are long opportunities, okay, long setups are high probability trades, and therefore we want to be searching only for long entries, okay? It doesn't matter, like I say, whether you are in a scalper. A daily chart in this case is the euro against the GBP, the sterling pound, on the daily time frame, okay, long-term perspective. The chart goes back about half a year, even 7 months actually, and as we can see, the moving averages pointing up, okay, all of them in order, price nowhere near the 100, the price harmonically swinging off the dynamic area of support in this case, since we are in an uptrend. So you see, this is the area between the 30 and the 50s. You can see it's holding indeed as it's working as a dynamic area indeed of support. Okay, every time the moving averages catch up with price, they muscle price to the upside. Okay, price in this uptrend, price cannot breach below the dynamic area of support. Okay, if it did breach below, I would consider this trend weakening down, and therefore I would probably cancel any possible trading opportunity on this chart. Okay, so as you can see, no matter what currency pair you like to follow, no matter what time frame you like to base your trades on, those 6 conditions are, when they apply, when they all fall in line, and the moving averages are lining out as I like them to see, okay, as I like them to be, as I like them to plot in my chart, with those 6 conditions falling in line, you are looking into solid trend. Okay, the moving averages point you in the direction of high probability trades. In this case, clearly you want to be searching for long entries. Long entries are high probability trades. Short entries are a bad idea. Okay, when you see the moving averages, when you find this type of trading setups, okay, when the moving averages are plotting on your chart this way, fulfilling those 6 conditions, you don't want to trade against the moving averages. Don't trade against the market flow. The market is telling you, the moving averages are telling you that this market is buying the euro against the sterling pound. Therefore, you don't want to be short here. Okay, you don't want to enter short here. You only want to be searching for long entries in the direction of the market flow. Okay, why would you want to fight the market flow if you can swim in the direction of the flow? Okay. In fact, let me show you another chart where the moving averages are, well, basically not falling in order, not pointing in the same direction, etc., etc. In this case, is the euro against the Japanese yen on the 1 hour time frame. Okay, and as you can see, well, first of all, we have plenty of crossover. Okay, moving average crossovers. Well, the moving averages are pointing, each of them is pointing in a different direction. They are certainly not in order. Price is not respecting the dynamic area of support and resistance at all. I mean, price is in fact breaching above and below, breaking the 100 moving average a number of times throughout the chart, etc., etc. Whenever you see this type of price action, basically what you usually have is a ranging market condition. Okay, in fact, if I draw 2 horizontal lines, we can see how price has been, well, bouncing up and down without any clear market direction, and therefore, any type of trading decision you may take on this type of charts, it's going to be a low probability trade, because there is no the bulls and the bears are, well, let's say undecided as of where they want to push price, as of in which direction this chart is heading to, as of in which direction price is heading towards, and therefore you don't want to search for trading opportunities. I always say that if there is no trend, there is no trade. It's pointless to try to risk your money searching for trading opportunities in this type of market condition. Price is chaotically bouncing up and down. Okay, with the moving averages crossing each other, not parallel to each other, not in order, etc., etc., is to not trade at all. That's to stay out of the market. That's the best trading decision you could take at this junction of the chart. Okay, actually, just compare this chart I'm showing you right now, euro against the JPY on the 1 hour time frame. Compare this chart with this one. For example, with the one I was showing you before, the first one I showed you at the beginning of this video, the American dollar against the Canadian dollar. This one clearly shows a market bias. Okay, the market is selling the American dollar against the Canadian dollar, and therefore You want to follow the market. You want to be searching for short entries in this market. The market bias is very clear. The moving averages are telling you exactly the direction as of where you should be trading, either long or short. In this case, clearly short. Whereas in this other case, okay, well, the market is basically telling you nothing. It's just telling you, stay out of this mess, okay? Do yourself and your trading account a favor and stay out of the market. All right, now, I've already talked about those 3 simple moving averages, and especially how those 6 conditions can help us determining the health of a trend, how solid is the trend, etc., etc. But now I want to show you how to realize in advance when the trend is about to get, to get in troubles. When it's perhaps how to hear early warnings, early bells of warning that the trend may be coming to an end, or at least maybe slowing down, and we might want to be out of the market, to not consider trading that trend anymore. Okay, I'm going to show you another chart now. It's the Canadian dollar against the CHF on the 4 hours time frame. It's a pretty zoomed out chart because well, this trend has been in place for ages. It's a long trend. But I want to show you. I want you guys to focus on the right end of the chart. As you can see, well, all this time along, price has been bouncing very harmonically off the dynamic area of support. In this case, as we're in an uptrend, it has indeed holding price above. All the moving averages have been in order. The 30 above the 50, 50 above the 100, all of them parallel to each other. All of them, meaning that there's no crossover, all of them pointing the same direction, meaning up, etc., etc., etc. Price nowhere near the 100, etc., etc. So basically, what we are looking into is a very strong uptrend. Moreover, it's been in place for, like I say, a number of consecutive weeks. So it's certainly been quite a beautiful run up, okay, all the way from here, okay, where the moving averages fell in line, all the way, well, up to here. This has been a beautiful run up. As per the moving averages, they've remained in order, parallel to each other, pointing the same direction, etc., etc. So it's been basically quite a long, beautiful, nice run up. Okay. Now, if we focus on the right end of the chart, I'm going to be scrolling very slowly, like I say, towards the right, and you will see how price unfolds and how we may read price action in real time to get those early bells of early warning that the trend might be coming to a halt, okay, might be slowing down, and we may want to not take trades anymore in this trend. Okay, now I'm going to be scrolling to the right, and bang, we have our first signal of warning right there. Okay, have a look at how price touches the 100. Okay, upon the last swing up, okay, which is this one I'm marking right now, we have a retracement, okay, right there. And then actually, let me zoom in a little bit, sorry about that, guys. Let's see, I keep scrolling. Full-bodied bars, red bars, and in against the trend all the way back to the 100. They indeed touch the 100. They break below the dynamic area of support, which had been working. Okay, remember when I said a quick breach below the 50 is all right. But this is not a quick breach. Okay, this is a full breakout, a momentum breakout. Moreover, since we have 2 consecutive long red bars with no wicks, all the way back to the 100. Remember what I was saying before, then when in an uptrending, the pullback goes all the way back to the 100, it usually takes quite a deep bite into the trend. Well, have a look. We are almost back to the level where the swing started, okay? we gain, the bulls gain all this ground to the bears, but then they gave it up straight away to the bears, back to the bears in the pullback, and indeed the 100 moving average was touched, and as far as I'm concerned, as far as my system, my 3 simple moving average way of reading or gauging the trend, well, this is a clear signal of trend weakness. Okay, now if I keep scrolling, we will see how now we don't have the moving averages pointing in the same direction. Have a look at the 30. The 30 is pointing down, is it? Can you see that, guys? The 30 is pointing down. Now we don't have them all pointing up anymore, do we? They've been pointing all of them up all the way along, okay, throughout this part of the chart. However, at this point right there, we touch the 100. Now we have one of the 6 conditions is not applying anymore. Price has touched the 100. Okay, now another condition that is not applying anymore, price is not remaining above the 50. Okay, in this uptrend, price is not spending most of the time on the right end of the 50 simple moving average. We've had, remember when I said 1-2 bars below is okay, but now we've had 1, 2, 3, 4, 5, 6, 7 bars. You know, that's definitely price is not spending time at the right end of the 50 anymore. Now, moreover, another conditions that's out of place now. The 30 is not pointing in the same direction of the 50 and the 100. Another condition that's being wiped out, that's 3 out of 6, that within a minute, within few bars, from that point on, well, they've been basically wiped out of the list. Okay, now let's keep scrolling. Bang, we have a crossover right there. You see that, guys? We have the 100 touched. The 30 is not pointing up anymore. Price is batting around under the 50 for way too long. Now we have a 30 moving average crossing over the 50. Okay, well, this trend, this is not a trend anymore. Okay, in fact, we can clearly see on the chart that we are trending no longer. We are now moving within a congestion area. We are moving sideways. I don't need no indicator. I don't need to draw no trend line. I only need to read price around my 3 simple moving averages. I just need to have a look at how the moving averages are plotting in my chart, and instantly I can tell you whether this trend is still in place or not. All the way up to here, okay, all the way up to this breakout of the 50. It was a beautiful trend, price nicely bouncing up. Now from this point on, we are trending no more. Okay, to here. That was a beautiful trade, a beautiful trend. Long trades, long opportunities, long setups were high probability trades all the way up to here. From this point on, when we begin moving sideways, the moving averages are not showing are not fulfilling all the 6 conditions anymore. In fact, wow, we've thrown 1, 2, 3, 4 conditions out of the list. There are a number of conditions now that have been broken, and well, therefore we are certainly not considering any, or I personally would not be considering any more any long entry any longer. Okay, like I said, we are consolidating sideways, and I don't trade within ranges. I only trade within trends, okay, such as this time around, this earlier part of the chart. Okay, so now you don't need to plot that many indicators on your chart. Okay, you don't need to cluster your charts with a number of indicators, getting confused with different signals from all those different indicators, MACDs, stochastics, Bollinger Bands, etc., etc. That's just an overload of information, and you quite frankly don't need it. Okay, you just need 3 simple moving averages on your screen. You need to analyze how they are plotting on your chart, whether they are in order, whether those 6 conditions are applying. You need to read price around those moving averages, whether the dynamic area of support and resistance is holding, whether price is indeed spending most of the time at the right time of the 100, whether we get any crossover, etc., whether we are ranging. That's very important. Are we trending or are we ranging? If we are ranging, we don't want trades. Those are low probability trades. We only want trades on the trending part of the chart. Okay, all the way here we want to be searching for trades. At this junction of the chart, we want to be searching for trades no longer, because those are low probability trades. Excuse me. Okay, that's basically all, guys, for this first video. Now what I recommend you is to scroll back in your charts, search for it doesn't matter what time frame, it doesn't matter what currency cross you choose. Okay, search for times in your for those periods in your charts where those 6 conditions have been applying. Okay, draw those, plot those 3 simple moving averages. Scroll back in your chart, search for times when those 6 conditions have been applying, have been fulfilled, and you will see that you were looking into healthy trends where most of the trading signals were winners. Okay, I don't want to get into trading signals, entries, exits, etc., in this video. I will leave them for future chapters, future videos, but for the time being, I recommend you to scroll back in your chart, experiment with those 3 simple moving averages, the 30, 50, and 100. Search for those 6 conditions to be fulfilled, and you will see by yourself, with your own eyes, how when those 6 conditions are indeed applying to the chart, you were looking into solid, high probability trends, strong trends, and that's precisely the type of price action you want to trade. Okay, all right, folks, that's all for this video. I will be seeing you in the next video. Bye bye. Hello there, this is Hector. Welcome to a new video of my Forex trading course. In the previous video, we've reviewed the 3 simple moving averages I like to use in order to search for trends, and more specifically, the 6 conditions I like to be fulfilled before, labeling a trend as a healthy trend. Okay, remember, all those 6 conditions were having having the moving averages all in order, all pointing in the same direction, parallel to each other. Price nowhere near the 100, etc., okay. Well, if you remember, the last condition, the 6th condition, was to have price harmonically swinging off the dynamic area of support and resistance, which, if you remember, it was the area between the 30 and the 50 simple moving average. All right, I do understand that this 6th condition might not be as intuitive, as easy to understand as the previous 5, and that's the reason as of why I have prepared a quick video, short video, so you guys understand this concept perfectly. Okay, as you can see in my screen, I have 3 charts. They are basically the same chart. They are all the euro against the Australian dollar, and spanning from the 30th of May 2007. As you can see, they all begin at the 30th of May 2007, and all the way to the 13th of June 2007. Okay. So basically, they span for about 2 weeks, more or less, like I say, from the 30th of May to the 13th of June. Yeah, about 2 weeks. Now, the question is, which time frame does this downtrend belong to? Okay, it's clear that we are downtrending. Okay, it's clear the price is clearly downtrending between these 2 dates. Now, is this a 4 hours time frame, or is it a 1 hour time frame, or is it finally a 30 minutes time frame? Now, we are going to be using the sixth condition to determine whether this trend or what time frame fits this trend the best. All right. As we can see, all of them have the three moving averages pointing down, parallel to each other. All in order, etc., etc. Actually, let's begin with the 4 hours time frame. Let me expand out the 4 hours time frame so we have a clearer picture. All right, in the 4 hours time frame, as I was saying, we can clearly see how all the three simple moving averages are in order. Price nowhere near the 100. They all point in the same direction. Etc., etc. Okay, so we are downtrending. Now, what about the sixth condition? Remember, having price swinging of the dynamic area of support and resistance. Well, as we can see, how price, well, every time we have a pullback, price fell shy of the dynamic area of resistance. It doesn't quite reach that area. It doesn't quite even reach the 30 simple moving average, which is the first moving average of all. Price is not hugging the dynamic area of resistance, all right? Sure, they are all in order. Sure, they are all parallel to each other. Sure, they are all pointing in the same direction, etc., etc. But the sixth condition is not fulfilled. Price is not hugging, is not swinging off the dynamic area of resistance, okay? It's always it falls shy, like I say, of that area. It doesn't quite reach that area. So the sixth condition on the 4 hours time frame is not fulfilled, is it? Now let's have a look at the 30 minutes time frame. As you can see, this is a pretty zoomed out chart because, well, I need to it's a much shorter time frame, and therefore I need to squeeze in my chart in order to, well, to fit it on the screen. Now, in the 30 minutes time frame, what we see, well, we see a number of crossovers there. The moving averages are crossing over. Moreover, every time price retraces or pullbacks, well, the dynamic area sometimes doesn't quite even hold price. It goes all the way back to the 100. In fact, it breaches above the 100. Like I said, number of crossovers there, and all the crossover there, etc., etc. So we have a few different conditions not being fulfilled. All right. Now let me go into the 1 hour time frame. Expand this chart, and as you can see, well, the conditions are better fulfilled on this time frame. Okay, firstly, yes, we have the moving averages pointing in the same direction. Yes, all parallel to each other. Price never breaching the 100. And finally, what about the sixth condition? Well, it is indeed applying. Have a look. Price, every time it swings, okay, the dynamic area, the area between the 30 and the 50 moving average, indeed holds the retracements. Okay, sure, we have a little breach above, but immediately after it goes back down without getting anywhere near the 100. Okay, and moreover, every time we have a pullback, price hacks the dynamic area of resistance. Okay, always mark the area between the 30 and the 50. That's a decision taking area. That's where, well, we want the pullbacks to end, and from there, find resistance. Price turns around, and a new swing is created. Well, in the direction of the trend, in the direction of the moving averages. Okay, so as far as the sixth condition, this is clearly a 1 hour time frame. The 4 hours time frame, sure, it also fulfills all the different 5 conditions, but it does not fulfill the sixth condition. Price is not hugging the moving out the dynamic area up on the pullback. Okay, it always falls shy of that area. Moreover, in the 30 minutes time frame, as I was saying, well, this one. Actually, we have a number of conditions that are being violated, are being not respected, with those crossovers, with price reaching the 100, etc., etc. So if we were to search for trading opportunities in the euro against the Australian dollar throughout this nice downtrend, the best time frame to search for opportunities would be the 1 hour time frame, because all the conditions are respected and because price is harmonically swinging off that key area, the dynamic area of support and resistance. Now, why is it important to have price harmonically swinging off this area? Because it warns us in advance when the trend might be coming to an end. Now, let me go back into the 4 hours time frame. At this time, right at the end of this trend, we see price reaching back to the dynamic area of resistance. Okay, at this time, the moving averages are still pointing down. They're still in order, etc., etc. So, from a technical point of view, we are still in a downtrend. Okay, so upon this pullback, we might be tempted to begin searching for short opportunities for a whole new swing to the downside. However, this is a mistake, and the reason it is a mistake is because we were not looking into this trend on the right time frame. This was not a 4 hours time frame. This was a 1 hour time frame. So if we search for short opportunities, once price pulls back to the dynamic area on the 4 hours time frame, like I say, we might be looking to enter the market at the wrong time. Okay, at this precise time, this trend has already lost momentum, has already lost steam, and it's already weakening down. Okay, if we were to follow this trend on the right time frame, meaning on the 1 hour time frame, actually let me zoom in a little bit more and scroll back right there. Okay, at this time we already had early signals of warning that we may not want to be searching for short opportunities anymore. Firstly, okay, all the way along this was a nice downtrend. The dynamic area is holding price. Yeah, we have a breach above that, but immediately after it goes back down all the way until here. And now let me explain you why. All the way until here, the moving averages were pointing down, the dynamic area was respected, they were all in order, etc., etc. But at this point, the dynamic area gets breached. Okay, it does not work as resistance anymore. Let me take off this line. At this time of the chart, at this junction, the dynamic area, the moving averages don't hold price below anymore. They stop working as resistance. Okay, they were working as resistance there. They worked as resistance there, and again, and again, and again, and again. But bang! They don't work as resistance anymore here. In fact, price breaches above the 100. Okay. Moreover, at this precise junction of the chart, have a look at what happens to the moving averages. They are flattening out. Actually, they are not pointing down anymore. They are pointing sideways. Okay. It was an early indication that something is wrong here. This trend, this beautiful downtrend, is losing momentum at this junction of the chart. Okay, the dynamic area is breached. Okay, the sixth condition is breached. Now the 100 is breached as well. We have another condition down the loo. Moreover, the moving averages are flattening out. Okay, another condition that goes out of the window. Moreover, we have a crossover. So at this precise time, we have plenty of early signals of warning that we do not want to search for short opportunities anymore. And in fact, bang! Have a look at what happens. Just the next day over, price shoots above. The trend comes to an end, okay, and the moving averages begin to point up, all right? If we were to search for, if we were looking, following this trend, on the 4 hours time frame, at this time, okay, at this precise junction of the chart, we will still be tempted to search for short opportunities, and as you can see, it would have been a losing trade, okay? Price shot up for, actually, about 150 pips and we obviously would have scored the loss. Now, if we were looking into the right time frame, into the 1 hour time frame, at this precise time, we already knew that something was wrong with this chart. The 100 is breached, moving averages flattening out, crossover, etc., etc. Okay, number of conditions are falling out of place, one after the other one, and well, you know, at this time you don't want to be searching for short opportunities anymore. Bang. You know, it would have been a losing trade. This is the importance of following a trend on the right time frame. Okay, in this case, on the daily time frame, because as you can see, well, the sixth condition was telling us that the best time frame to follow this trend, this euro against the Australian dollar, was indeed the 1 hour time frame. Not the 30 minutes time frame, not the 4 hours time frame, the 1 hour time frame. And we got that clue. We knew that the 1 hour time frame was the right chart to follow from the sixth condition, how price respects the dynamic area of resistance all the way until here, where things begin to get ugly, and at this point we want to search for trades no longer. All right, guys, that's all for this video. I hope you understand now the importance of having price harmonically swinging off the dynamic area of resistance or support, depending whether we are in an uptrend or in a downtrend, and why that condition is important to be fulfilled, and why it's important once we spot a downtrend in a scenario to scan or to follow that trend on the right time frame. Okay, to to understand or to label a trend as a 1 hour time frame trend or as a 4 hours time frame trend, etc., etc. It doesn't matter what time frame the trend belongs to, as long as we follow the trend on the right time frame. Okay, in this case, as I was saying before, it was clearly the 1 hour time frame. Alright guys, that's all for this video. I hope you understand now what the sixth condition is all about. However, if you have any question, please don't hesitate to drop me an email. I will very gladly answer back all your questions. Alright? Okay, I'll see you in the next video. Hello everyone, this is Sector, and welcome to a new video of my training course. In this video, I'm going to be talking about one of the main elements of my trading system. That's the dynamic area of support and resistance, which is basically the area, the band between the 30 and the 50 simple moving average of the close. All right. This is in this chart, in the chart that you are seeing right now, the 30 simple moving average is marked in red, in green, the 50 is marked in red, and the 100 is marked in blue, while the dynamic area would be this band, okay, this area within the 50 and the 30. All right. In my opinion, it's a very important area. And as a trend trader, I always like to keep an eye on the dynamic area, because it's a good indicator as far that we can use to to read the overall health of the trend. Anyway, I'm gonna now be showing you some some different charts in different time frames and different currency pairs, so you can see the dynamic area of support and resistance in play. The reasons also why I'm showing you different charts and different, like I said, currency crosses and different time frames, is so you understand that this is a universal principle. It applies to all the time frames, and well, basically, it's as why I consider it one of the main elements of my trading system. All right, okay. First of all, there is one requirement that we need to make sure that actually applies to the to that particular chart that we are looking into at that precise time, before before trying to analyze or trying to take any trade from the dynamic area of resistance or support, and that requirement is that there must be a trend in place. All right. I was just mentioning how the dynamic area of support and resistance is the area between the 30 and the 50. Well, that's not totally accurate. Okay, it's a dynamic. The area between the 30 and the 50 in trending markets, and only in trending markets. That means that let me scroll back in my chart, for example. Okay, all right, right here, right now I am showing you a range bound market. Okay, very clear range bound market. Prices basically whipping up and down, and then up and then down and up and down again. Basically it's moving sideways, or at least it's definitely not moving in any particular direction. There is no particular bias in this chart. Okay, well, in this case, the area between the 30 and the 50, meaning between the green and the red moving average, holds no significance whatsoever. All right, as you can see, this area is being breached up, breached down, breached up, breached down once again, so on and so forth. It has no relevance whatsoever in non-trending scenarios. Okay, so whenever you are to apply the principles I'm going to be showing you on this chart, make sure that first of all you are indeed looking into a trending market, okay, into a trending chart. As we saw on the first video of this trading course, as far as I am concerned, a trending chart, a trending currency pair is that shows my three main moving averages, okay, the 30, 50 and the 100, 30, 50 and 100, all of them in order, all of them parallel to each other, price nowhere near the 100, price spending most of the time in the right side of the 50, etc., etc. Okay, so like I say, always make sure that you are actually looking into a trending chart before trying to apply the concept of the area of dynamic support and resistance. Otherwise, like I say, this area holds no relevance whatsoever. All right, okay. Most of the time in trending markets, okay, we've determined already that we are in a trending in the trendiness scenario. In this trendiness scenario, in this type of market conditions, most of the swings, at least in a healthy trend, are contained, okay, or let's say they bounce off this area between the 30 and the 50 moving average. The reason as of why I like to keep an area on the dynamic area of support and resistance, basically the reason as of why it works is because institutional players like to keep an eye on this area, okay, on these retracements, in order to adapt to their positions. All right, I'm talking about, of course, large investment banks, hedge fund managers, etc., etc. You know, the people who trade volume enough to actually move the market. As you guys know, Forex is an enormous market, and you definitely need large capital to have an impact on it, okay, and that's only investment banks and institutional players have the capacity to have their individual positions to have any sort of impact on these large markets of Forex. So these guys, the large traders, they basically are all of them trend traders themselves, and well, of course they all follow different trading approaches, but basically they sell pullbacks in a downtrend, or they buy retracements in an uptrend. Okay, let's say you have an uptrend, and they basically buy the pullbacks. All right, price retraces back, okay, and they adapt to their already long position, okay, and therefore price moves forth into a new swing. All right, then upon the pullback they adapt to their position, and so on and so forth. Okay, same thing as in a downtrend. And I know for a fact that they do like to keep an area on these retracements areas to around the 30 and the 50 simple moving average to adapt to their position. All right, so let's say that the area between the 30 and the 50 moving average is a decision-taking area. Okay, it's an area that you know there are going to be loads of enormous limit orders. Okay, either sell or buy limit order, depending on what side of the market you are, of course, depending on whether you are in an uptrend or in a downtrend, and you know that price is bound to react in some way to that area. All right, if let's say we are in this clear downtrend, all right, and price pulls back to the dynamic area of resistance, in this case since we are in a downtrend, if we have enough limit orders stuck up at this area from different institutional banks, from different hedge fund managers, etc., to create a new swing, those limit orders will be stuck up, like I say, in this area between the 30 and the 50, and therefore, bang, a new swing will be created. Upon the next pullback, same thing. If there are enough orders at this part of the chart, at this junction of the chart, a new swing will be created. Okay, always in the direction of the main trend. Otherwise, if the institutional players have lost interest in this chart, in this currency pair, price, in the other hand, will continue moving up. All right. So that's basically the reasons of why I like to keep an area on the dynamic area of support and resistance. It's a decision-taking area, you know, an area where if the trend is to survive, most of the swings should spring off that area. All right, should be created off that area, and therefore 95% of the price action will be contained at the right side of that area. Okay, let's assume this is about, well, you know, let's picture the dynamic area as a boundary, all right, as a frontier. If the trend is to you know, to still be in place, price, or at least 95% of the price action should be contained on the right side. In this case, since we are in the downtrend, it should be contained on the lower side of the dynamic area. Okay, as soon as we breach this area, all right, as soon as we break above and we begin to have, you know, enough price action above this area, well, the trend is definitely weakening. All right, or even, you know, finished. Right, or even, you know, finished. All right, now I'm gonna be showing you some charts now that I have explained the basic, you know, the theory, let's say, behind the dynamic area of support and resistance, and so you can, you know, see by yourself how price reacts off this area, always in trendiness scenarios. Okay, like I was saying before, if there is no trend, there is no point in having a look at the 50 or the 30 simple moving average, because they are irrelevant. Okay, they only work in trendiness scenarios. All right, there we go. First of all, in this case, the chart you've been seeing all throughout this video is the USD against the CHF in the 1 hour time frame. All right, upon this level, okay, upon this moment, this time of the chart, the moving averages fall in place. All right, as you can see, the 30 is below the 50 and the 50 is below the 100. Moreover, price is nowhere near the 100. Okay, all of them are parallel to each other, etc., etc. Fine, we are in a trendiness scenario as per my trending conditions. Okay, from this moment on, I am liking my main trading strategy will be to wait for pullbacks, all right, to the dynamic area of resistance, and from there I'm going to be searching for short entries and only for short entries. Okay, of course, I'm not gonna enter any trade just as price retraces back, all right, just as price retraces back to the dynamic area of resistance, I am not just gonna, you know, enter short in the market out of the blue. Okay, I'm gonna be searching for my entry signal will be basically triggered on the short time frames upon a reversal price formation here. Okay, I don't want to get into that. I explained that. I explained the reversal formations in chapter number 3 of this trading course. For the time being, I just want you to, you know, I just want you to more or less have a picture of how my trading system goes as far as the entry, and actually more than the entry, at as far as where in the chart I would search for those entries. Okay, all right. So, like I was saying, we have a downtrend, right, guys? In this downtrend, we have a pullback back to, well, first of all, we had this pullback, then we had another swing down, and now another pullback to the dynamic area of resistance. In this case, I would be, like I said, searching for reversal formations in the short time frames in order to enter short in this market. If I do get this, if I do get a reversal formation on the short time frames, I would enter short. Always and only short, since we are in a downtrend, and then I would ride a price for a new swing to the downside. Then I would, of course, set my my final targets, okay, which are explained on chapter number 4, and I would exit taking my profits off the table, okay, cashing this on this trade, and then wait for the next opportunity. The next opportunity comes here. Okay, we have another retracement back to the dynamic area of resistance. In this case, we just beep the 30 simple moving average, but nonetheless we do get there. All right. All right, good, fair enough. Then I would, once price retraces back, okay, I usually, one of, a trick of mine is to always set a sound alarm few pips below the 30 simple moving average, right, before reaching the 30 simple moving average. So whenever I have a trend in a scenario, like I say, I place my sound alarms 10 pips before that, 10 pips before the 30 simple moving average, so I get warned whenever price retraces back, so I can follow price action in real time. But like I say, I don't want to get into that. I explained that on the chapter number 3. For the time being, I will just say that in this case, upon having taking this short entry and hopefully cashing in some profit, I would wait for the next opportunity. This next opportunity comes here, retracement. Then I would zoom once again into the shorter time frames. Once again, I would search for a reversal formation at that level, always looking for bounces down of the dynamic area of resistance. Okay, we have the retracement. I would search for a bounce down in the direction of the main trend. Bang, trigger short entry, write it down. Next opportunity, same thing, retracement up to the dynamic area of resistance. Okay, search for reversal formation. If it does happen, if I do see a reversal formation, if we do get a bounce down of here and write it down. Next thing up, okay, next swing up, next pullback, same thing, pullback back to the dynamic area of resistance. Zoom into the short time frames, search for a reversal formation. Do I see that reversal formation? Do I see a bounce down of that level? Enter short. Bang, new swing down. Okay, you are trading high probability chances. First of all, you are trading in the direction of the main trend. Okay, that's crucial. All right, guys. As I was mentioning on the first video, if you do not trade in the direction of the main trend, you can forget about achieving any type of consistency as far as trading goes. Not only forex trading, it doesn't matter whether you're trading forex, I don't know, stocks, futures, oil, corn, no matter the market you're trading, the only way to achieve some sort of consistency in this business is to trade always with with the trend on your side, okay, with the moving averages pointing in the on the trading direction, and that's the way I personally do it. Okay, like I say, it's the only way to make sure that you are stacking up the odds on your side. All right. So like I say, these are high probability chances. First of all, you have the trend on your side. All right. Second. Second element on your favor, you're not just entering at any time, you're just not taking entries out of the blue. You actually wait for a pullback to an optimum area, okay, to an area of decision taking, to an area where if the trend is indeed going to continue, if the trend is indeed to to trend on, it will be from this area, from the area between the 30 and the 50 in most cases. All right. Like I say, you're not entering here or here. I mean here or here or here. No, none of that. You're basically waiting for a pullback to the optimum area. Once you get your signal, bang, you enter short. Okay. Always you wait for the perfect time, the area between the 30 and the 50 simple moving average. All right. So that's two elements of your favor: the trend and the dynamic area of resistance. Moreover, third element on your favor: you're just not entering right as we retrace back. All right, I never enter. I never, let's say, place a sell limit order somewhere around here. I never do that. What I do is, upon the retracement, is if I see that price begins to curl around, if I do get that reversal formation, which, like I say, I will get into that on the chapter number 3 of this course. If I see that price begins to curl down upon bouncing from that level, then I enter short. That's my confirmation. All right. Like I say, upon a retracement, I don't quite sell right there. No, sir. If I will only enter short if price begins to curl down in here. Okay. Once I get the confirmation that the dynamic area of resistance is indeed holding price, and price begins to curl in the direction of the main trend, and then I will enter short. Okay, same here. I don't short here. I wait for the turnaround, and there is where I would enter short. Okay, and ride a new swing to the downside. All right. So you are stacking odds on your favor. At the end of the day, trading is a probability. It's a probability game. All right, guys. I know you've probably read over the internet that trading is complicated. Trading implies many different super complicated systems, super complicated indicators. That's not the reality. Okay, trading is all about mathematics. It's about probabilities. Okay, money management. Are you trading with the odds on your side? All right. Are you trading in a trending scenario? Are you trading moreover in the direction of the trend? Okay. Are you trading at the optimum area of the chart? Are you waiting for the confirmation? Okay. Are you waiting for the confirmation that the trend is indeed holding and a new swing may be creating? Okay, maybe about to be creating. Okay, maybe about to be created actually. Okay, you are basically, like I say, stacking up chances, odds on your side, and that will increase your win-loss ratio. Instead of scoring a 50-50, okay, you will be trading on a 60-40, 70-30, 75-25, 80-20. All right, you are stacking up chances on your favor. All right, and in order to do that, you've got to analyze your chart. You've got to analyze whether you are trending, whether you are trading at the right time of the chart, etc., etc. Let me now show you another chart. Okay, in this case, we've now just seen the USD against the Swiss franc. That's American dollar against the Swiss franc, on the 1 hour time frame. Now I'm going to show you a complete different currency pair in a complete different time frame. Okay, this is the sterling pound against the American dollar, what we usually call in the forex market the cable. Okay, we call the cable for this currency pair on the weekly chart. All right, very long-term chart. All right. Now let's analyze this chart. Why not, guys? All right. First of all, how are these moving averages plotting on my chart? Well, first of all, I see they are all in order, aren't they? 30 is above the 50, and the 50 is above the 100. Good. All right. Moreover, I can see that they are all pointing in the same direction. They are more or less parallel. All right. More or less parallel, especially the 30 and the 50, which are the two most important ones. Price is nowhere near the 100. Okay, you see, this is the 100 moving average, and price is very far away from it, isn't it? Okay, and well, and moreover, price is swinging harmonically off the dynamic area of support. All right. Swinging harmonically off the dynamic area of support, isn't it? All right. Then we are in a clearly trending scenario. Yep, it's certainly a trending scenario. So in this case, now that we've recognized that we are in a trending chart, okay, now the area we want to keep an eye on is the area, remember, between the 30 and the 50 simple moving average. All right. And especially the bounces, okay, the pullbacks to that area, in order to confirm or to verify whether we get a bounce off that area. And we actually do. Okay, just have a look at the chart. Every time price, the cable in this case, retraces back to the dynamic area of support. By the way, this is the dynamic area of support. Since we're in an uptrend, it will be called resistance if we were in a downtrend. Okay. All right. Every time, as I was saying, every time price pulls back, right, to the dynamic area of support, you know, all the enormous amount of limit orders, okay, buy limit orders in this case, in order to go long, are enough to hold price below. So every time price goes down, like I was saying, this is a decision taking area, and price reacts of that area. Okay, pullback, reaction, pullback, reaction. All right, it happens many times. That means that this is a healthy trend. Okay, it's a trend that's carrying enough momentum to the upside. Okay, every time the bears manage to pull price down to the dynamic area of support, the bulls come in play. The bulls regain control of the situation and bang, push price to the upside. Okay, another pullback. The bulls once again come in control and, you know, basically slap the bears in the cheek, and bangs goes to the off it goes to the upside. Okay, it's always important to make sure that upon every bounce of the dynamic area of support, we score new highs. All right, we breach the previous high, then we have a retracement, we bounce off that area and we score a new high. Another retracement, off it goes, scoring new highs. Another retracement, off it goes, scoring a new high. Okay, always remember, guys, that from a very basic point of view, a trend is nothing but a consecutive string of higher highs, all right, and higher lows. If you see that your chart is making higher highs and higher lows, all right, you are basically uptrending. Okay, as I was explaining on the first video of this course, just making higher highs and higher lows, it's not enough, in my opinion. You want the moving averages to, you know, plot under certain conditions in the chart, as usual, all of them in order, all of them parallel to each other, etc., etc. So in this type of trending scenarios, like I say, every time, if when price pulls back to the dynamic area of support, and if it does not breach it, all right, if it does not breach it, meaning that if this band actually is strong enough to hold price, all right, upon the retracement, okay, upon the retracement, if it's strong enough to turn price around in the direction of a very clear trend, entering long there would have been a high probability trade. Next retracement, same story. We reach the dynamic area, we see price beginning to turn around. This would have been a nice long area, or a nice area to enter long for another swing up. All right. That's basically what I do in my usual trading approach. I search for a trending scenario, alright? I keep an eye on my dynamic area of support. Then I wait for a pullback to that area, alright? I get a pullback to that area. And then, like I say, I read price action in the shorter time frames. If I see the beginning of a retracement, bang, I enter long there. And I ride it for a new swing up. And the next swing over, the same thing. Is the dynamic area holding the retracement? If it is, bang, there I go. I want to be long because I am in the direction of the main trend. I am buying, I am going long at the right time of the chart. I'm not going long here or here or here. No. I'm going long at the right as price turns around, as price pulls back and then begins to curl around in the direction of the main trend. That's the beautiful area you want to enter long from. All right. So, like I say, keep an area on the dynamic area of support when you see a trending scenario as per my moving average conditions, because that's a very strong area. All right. It's an area that price is somehow bound to react of it, either to breach it, okay, and if it breaches through, then you don't want to search for long entries anymore. Let's say this retracement didn't stop here, but instead it went all the way down here. That means that the dynamic area of support was not strong enough to hold the retracement, and therefore you don't want to be searching for long entries anymore. All right. As long as this area begins to holds price and price begins to turn around, and you zoom into the short time frames and you see a reversal formation as explained on chapter 3, you're good to go for a long entry. You are trading a high probability trade. Right, next, let me show you another example. In this case, the USD against the Canadian dollar. Okay, I'm gonna make this very quickly because, well, it's basically the same thing. First of all, we search, we analyze whether we are in a trending scenario or not. Yes, we are. All the moving averages in the same direction. No crossover whatsoever. Have a little bit of snaking around there. They get close to each other, but nonetheless there is no crossover whatsoever. Price nowhere near the 100. Have a look where the 100 is the blue line, remember, and price is very far below there, etc, etc. Okay, in a trending scenario, then what do? We keep an eye on the dynamic area of support and resistance. As usual, we wait for price to reach this area once again and have a look. Just look at the chart, okay? You don't have to believe me. Just look at the chart. In fact, just look at your charts. Go ahead on your own charts. Search for moments where all the moving averages were falling in order, pointing in the same direction, parallel to each other, etc., etc. And when that happens, see the reactions of the dynamic area of support and resistance. If price breached through, you would have taken no entry. If price, upon touching the dynamic area of resistance, begins to curl around, you are indeed about, or you could be about to be trading a high probability trade. Okay, like I say, don't trust me. Just go to your own charts, plot the 30, the 50, and the 100 simple moving average. Scroll back in time, search when they fall in order, and when they do, mark the area between the 30 and the 50. if that area holds, okay, if when price retraces here holds, I mean, of course, if price breaches through, search no more, okay, there is no trade to take there. But if it does hold and price begins to curl down in the direction of the main trend, just run some, let's say, some demo trades and see what would have happened. You would have made money. It's a high. You would have made money in the long term. Perhaps you may lose one trade. Of course, losing trades do happen in trading. Okay, they are unavoidable. I score many losing trades. You can browse through my blog and you will see that I indeed score losing trades here and there, just like any other trader. But as I was saying before, trading is all about probabilities and making sure that in the longer term, in the long run, the winners will outnumber the losers. Okay, and that will indeed be the case if you trade in the direction of the trend. If you wait for a price to pull back to the dynamic area of resistance, and then you trade as the turnaround begins to take place, and then you write it down. For example, here we got a pullback, but we didn't reach the dynamic area of resistance, did we? Then this would then have been a good entry. Patience is important when it comes to trading, guys. You're not supposed to trade every single setup you see in front of your charts. Okay, you've got to wait until all the right conditions actually apply. All right. In this pullback, we did not get quite to the dynamic area of resistance, did we? Okay, so if you traded as this was turning around, let's say there, that would have been an aggressive trade. I personally am a conservative trader. That depends on, you know, whether you want to be an aggressive trader or a conservative trader. I myself, I am a conservative trader. I don't mind missing out on few swings, like for example on this one, as long as my win-loss ratio remains high, meaning that as long as those trades that I do indeed take, they carry a high chance of actually becoming a winning trade. All right, and that's basically what I'm trying to teach you here. Okay, downtrend, retracement back to the dynamic area of resistance, begins to curl around. Let's say trigger your short entry there, bang. All right, same thing, retracement back, begins to curl around, enter short, bang. Here no trade, guys, we did not breach the dynamic area, but here we did, begins to curl around, short, bang. All right, as far like, once again, I've repeated 100 times, sorry about that, guys. I know I'm quite heavy here. Don't worry about the actual entry signal. I will explain that on chapter number 3 and chapter number 2, if I am correct. If I'm not mistaken, chapter number 2 and chapter number 3 displays all about entries. So as far as this video is concerned, don't worry too much about entries, but just mind the swinging, you know, the harmonic swinging, no trade here, the harmonic swinging formation. All right, and keep an eye on the dynamic area of support and resistance. All right, okay, another chart, why not? Another uptrending chart, beautiful uptrend with those moving averages nicely parallel to each other, nicely pointing the same direction, price steering clear of the 100 moving average, etc, etc. And in this case, price indeed holding, you know, if we draw a solid band between the 30 and the 50, we can clearly see that price is holding, I mean that band, the dynamic area of support in this case, it's clearly holding price above, and if it does, it means that this is a healthy uptrend. We have a quick pierce below here and another quick pierce below there, but you know, it's a quick pierce below, but immediately after it shoots back up. That's all right. Okay, markets are not perfect. As long as you don't begin to get 1, 2, 3, 4 bars closing below the 50, as long as, you know, it's just a quick dive below, but immediately after, bang, it goes back up, then you are all right. As long as you don't begin to get multiple bar closes below the 50, as long as price gets nowhere near the 100, nowhere near the 100, that is okay whenever it begins to turn around. All right, in this case we can clearly see the same thing. We are in an uptrend, price retraces back. As soon as it begins to curl up, you're good to go for a long entry. Same thing, another swing up, you make new highs, retracement, reaches the dynamic area of support, price begins to turn around, trigger your long entry, bang, another swing up, you make new highs, retraces back down. We don't touch the dynamic area of support, guys. You see that? We didn't touch it. The retracement was not deep enough. If it's not deep enough and you decide to take an entry, that's an aggressive entry. I mean, you can, it's up to you, but please be aware that you are being you are definitely being more aggressive than I am myself on my own trading, but I respect every type of trading. In my opinion, the way I like to trade myself, it's to if there is no pullback to the dynamic area of resistance or support, there is no trade. Just that simple. In the next swing down, we definitely get the retracement back into this area, don't we? Well, it does hold it, okay? Price does not breach through. We get no closes, no multiple bar closes below the 50. Price gets nowhere near the 100. So yep, indeed, price, the dynamic area of support is holding price above. As soon as this thing begins to turn around, as soon as we see a reversal formation in the short time frames, enter long, and then you enter long, and we go through a period of consolidation. Seems like the market lost a little bit of momentum there, a little bit of steam, but nonetheless, even though we lost momentum and we were moving sideways, please keep in mind that the dynamic area of support was never breached. In fact, the moving averages, all of them continued pointing up, continued in order, okay? They kept on being parallel to each other, no crossover whatsoever, etc., etc. The trend is still intact, okay? The trend is still in place. It's just that we are going through let's say a momentumless part in this trend, but the trend is still indeed there. All right, it is still indeed there. You see, price never broke below the dynamic area of support. All right, never went near the 100 moving averages, and as soon as finally we gain some momentum, all right, bang, sure enough, the trend muscled price into the right direction, meaning up in this case, since we're in an uptrend. That's the beauty of trading in the direction of the trend. Okay, the trend, there are more chances that sooner or later, even though you may go through an area of consolidation, such as in here, all right, or here, there are higher chances that the trend will eventually keep push price to the in direction of the overall market sentiment, just as it did here. All right, it's just a matter of waiting, of spotting that you are in a trending scenario, and then waiting for the right time and the right junction of the chart in order to search for entries in the direction of the main trend. And that area, in order to search for entries, is of course the area of the dynamic area of support. All right, I'm going to show you one last chart. This video is getting too long already, so I'm going to show you one last chart and wrap it up for this topic. In this case, I am showing you the euro against the Swiss franc on an intraday chart, okay, on the 30 minutes chart, and just to show you that. Just as before, remember, I was showing you a chart on the weekly time frame. In this case, I'm showing you the 30 minutes. This concept works no matter the time frame, no matter the currency pair. All right, it works, it's universal, because it's based on trends, and trends happen both in the longer time frames, also in the intraday price action. Okay, it happens no matter the time frame, no matter the currency pair. So these concepts that I'm explaining on this video, like I say, are universal. All right. All right. Well, we open up our chart, in this case the euro against the CHF on the 30-minute chart. First thing of all, as usual, we analyze the moving averages. All right, the 30 below the 50, the 50 below the 100. Yep, we are in a downtrend so far. All of them pointing in the same direction. Yep, all of them pointing in the same direction, meaning down in this case. Yep, good. There is no crossover whatsoever. Price nowhere near the 100. It came close to the 100 there. You know, this was a moment of I'm not very sure. Perhaps at this time, perhaps this swing down, once again, it depends how conservative you are, but perhaps we would have been better off letting this swing go and not trying to search for an entry there, just because price got very near to the 100. But anyway, from an overall point of view, we can clearly see that we are, as far as my moving averages goes, and also as far as making lower highs, all right, and moreover lower lows, of course. Okay, have a look at that, how we're making lower highs and lower lows. Well, yeah, we can clearly state that this is a healthy downtrend. All right, now once again, what do we do in a trending scenario? We keep an eye in the area between the 30 and the 50 simple moving average, which is the one I'm drawing right now on my screen. Alright, and not only that, we keep an eye on that in order to wait for pullbacks to that area. Alright, we have a pullback there, but here it overshot a little bit, you know, farther up, you know, a little bit too much in my opinion, or for my taste. Okay, perhaps, like I say, on this swing down I would have passed on an entry. But as I was saying before, I'm a conservative trader. I'd rather take less entries, less entries than other traders, but at least having a higher ratio of winners as compared to losers. All right. In my opinion, there is no need to take every single trade, to trade every single swing or every single trend. In my opinion, there are so many trading signals across the board. You know, there are so many trading crosses, so many currency pairs, so many time frames, that there is always a nice trading opportunity somewhere out there. You don't need to squeeze every swing out there. If this pullback scared you out because it got too close to the 100 simple moving average, because you got 1, 2, 3 closes above the 50, which is not too many. 3 closes is not that many, really. It's not that bad. But anyway, if that sort of concerned you, just let it go. No worries. You will have another chance later on, and another one, and another one. You know, the markets are going nowhere. There will be trading opportunities all around the clock and all across the board. Okay, no matter the currency pair, no matter the time frame. So, like I said, relax. Don't try to squeeze every single swing. If this one, you know, if this one smelled fishy because the pullback was, you know, carried too much momentum, too much strength, and got in the nearabouts of the 100, just let it go. You know, you will have more of them. All right. Alright, let's assume we let this one go. We wait for the next pullback, which happens here, but it doesn't touch the dynamic area of resistance. Alright. Are you a conservative trader? Then don't take this trade. I personally wouldn't have taken this trade. I would have waited for this one. Retracement back up. Okay. We reach the dynamic area of resistance, the area of decision taken. Here, in between this area, is where we have to ask ourselves: will price breach through, or will price turn around? If it breaches through, then I cancel or I don't search for entries anymore, just like it did here. Okay, if it goes anywhere near the 100, I stop considering for entries. In the other hand, if it doesn't breach through, if the dynamic area indeed holds the retracement and price turns around and begins to move once again, to cruise once again in the direction of the main trend, enter short is a high probability trade. Next swing up, okay, another pullback. We reach the dynamic area of resistance. Another decision taking area. What's the chart gonna do? Is price going to breach through and touch the 100, or is it going to curl around in the direction of the trend? If it does curl around in the direction of the main trend, enter short there, man. It's a clear or it's a high probability trade. It is indeed a high probability trade. You are stacking up odds on your favor. You have the trend, you have the optimum area to enter short from, all right? And moreover, you are waiting for the confirmation. That's a high probability thing. You are basically sailing with the wind on your back. Okay, you're moving, you are trading in the direction of the main market sentiment, and moreover, you're waiting for the confirmation that the move is already beginning. You're not trying to anticipate the market's next move. If you enter short just as price retraces back here, then you will be trying to anticipate, to foresee the next market move. All right, that's not what trading is about. Trading is, I always say, one of my golden rules of sensible trading, it's that trading is not about prediction. Trading is about reacting quickly to what's already appearing on your chart. That's why you don't enter short as price reaches up here. You don't take the short here. You wait for the signal that price begins to turn around, and there is where you enter short. You are not, if you enter short as as price retraces back to the dynamic area of resistance, right there, you would be trying to anticipate. You would be playing, I don't know, an oracle. You would be trying to become an oracle, a forex oracle, like I say, trying to anticipate the next move. That's not what trading is about. You don't want to enter there, okay, because price just very easily could breach through. You never know. All right, in trading you never know what the next move is gonna be. That's why trading is not about prediction. Newbies try to predict, okay. Professionals simply try to react quickly enough. When they see the thing, the price turning around in the direction of the main trend, up on a bounce of an area of resistance, bang, they enter short, and bang, they score some profits. When they see the confirmation, bang, they enter short there, bang, they're ready for a new swing down. All right. That's like I say, always remember, trading is not prediction. Trading is reacting quickly. All right, that's all what trading is about. All right, guys, I hope with this video you I've laid out the basic principles of what lies behind the dynamic area of support and resistance, what it actually it's made of, and how I basically use it. Okay, how I basically use the area between the 30 and the 50. All right. Once again, I can't stress enough that if you do not have a trend, the dynamic area of support and resistance is useless. Okay, the 30 and the 50 moving averages are useless. All right. Always make sure that you are in a trending scenario, and then you can begin following price around the dynamic area support and resistance. Not before. If there is no trend, there is no trade. Okay. Alright, guys, that's all for this video. I hope with this video you realize of the importance of the dynamic area of support and resistance. It's like I said before, it's one of the main elements of my trading system. It works, okay, it does work once mastered, okay, once you've become comfortable enough with the idea, and of course you've taken many demo trades, and you begin to understand those reversal formations of the dynamic area of resistance in a clearly downtrending scenario, they become high probability trades. Trust me, it's one of my main trading techniques. Reversal formations at the dynamic area of resistance of support in the direction of the main trend is one of my main trading strategies. I will elaborate on those reversal formations on chapter number 3, like I say, but I in this video want you guys to understand the importance of, at least as far as my trading methodology goes, at least as far as my trading approach goes, the importance of the area between the 30 and the 50 simple moving average. Alright guys, wow, this video is getting way too long already. I hope you enjoyed it. Of course, as usual, if there is anything from this video that you don't understand, okay, if there is anything about the dynamic area of support and resistance that you quite didn't understand, or that I didn't know how to explain it properly, don't hesitate. I am just one email away. Send me an email and I will get back to you as soon as possible. Alright folks, I'll be seeing you in the next video. Bye bye. Hello guys, this is Hector. In this video I'm gonna talk about how to not expose yourself in a trade when a news economical release is about to come out, okay? It's important to not be in a trade when the news comes out, because if the deviation from the expected number, from the outcome of what the analysts actually predicted, if the deviation is larger than expected, okay, you might get some random spikes on the chart, okay, and any let's say you are short in this market, okay, your stop loss is around there, and the any news relating any of these two pairs come out that day at that precise time, you could get spiked out, okay. Your stop loss could be triggered in one run in any random spike, okay, within seconds. It's so fast that you just don't have time to react, okay. It happens within 5, 10, 20 seconds. So you've got to make sure that you are not in the market when the unless you've moved your stop to break even, okay. You've got to make sure that you are not in an open, unprotected position when the news come out, okay. Basically, what you've got to look for is, what you've got to first of all is analyze which currencies you are exposed to. In this case, since this is the Euro CAD, okay, you would be exposed to any news relating the Euro or the Canadian dollar, okay. And in our second pair is the Australian dollar versus the American dollar, so you would be exposed to any news coming out on the Australian dollar and the American dollar. Alright, okay, so today we're gonna go to the Forex Factory. Before at the beginning of our trading session, we're going to the Forex Factory economic calendar. We are going to see if there is any news coming out for any of these four currencies, okay. This is the Forex Factory website, okay. This is the economic calendar. Let's assume today is Friday, the 11th of May. It's not, but let's assume, okay. Okay, the first thing we see is that at 1 a.m. we have an economic release for the Canadian dollar at 1 p.m. Euro time, okay, is the employment data. That's an important one, okay guys. As you can see, it's marked as in red, okay, it's labeled in red, which means a high impact, a high volatility, that this fundamental release could cause a high volatility on the chart, okay, should the deviation,
actual data come deviated from what the analysts had expected. Okay, so we know that at 1 p.m. we have news coming out for the Canadian dollar, meaning that this chart, since this chart is related to the Canadian dollar, okay, at 1 p.m. could potentially see some random spikes, okay, at 1 p.m. So we've got the way I personally trade is to impose myself a blockout period for 2 hours prior to the trade. So if it's at 1 p.m. From 11 a.m. to 1 p.m. okay, I impose myself to not take any trade. If I get any entry signal, my system gives me any entry signal within this time span, okay, based on technical analysis, even if it's a valid entry from a technical analysis point of view, I'm not going to take it, because I know that at 1 o'clock p.m. No matter how solid my technical entry might be, some random spikes may stop me out, okay, and there is nothing I can do about it, okay. Trading is all about minimizing risks, okay. Any professional trader will tell you that trading is not about how many wins you score, it's about how small your losses are, or how small you cut your losses, okay. So don't risk it, don't expose yourself to the markets if you don't have to. If you know that there is a market moving fundamental release coming out at 1 p.m, you don't want to be in the market at 1 p.m, man, as simple as that, unless you've moved your stop to break even by then, alright? That's why there is this 2 hours blockout period. So if you enter, let's say at 10 a.m, you've got 3 hours, so the price could at least move 10, 15, 20 pips in your way, alright? 20 pips your way, so you can move a stop to break even, alright? The last thing you want to do is to have an unprotected position open when the news come out, because that's gambling, okay? It's basically like in a roulette in the casino, betting for either black or red. You don't know what's going to happen. It might go against you, it might go your way, you don't know. But at the end of the day, that's not trading anymore, that's gambling, okay? So that's the reason as of why I personally don't trade within the 2 hours prior to the news, because in 2 hours it's rather difficult that I get a move large enough to safely move stop to break even, alright? Perhaps I enter and still price meander about. It takes a little bit to take off in my direction, and the news come out here. I just haven't had the time yet to move a stop to break even. The news go against me, and bang, I am minus 40 pips within 10 seconds. Okay, that's very possible, and you don't want that. Okay, so first rule: 2 hours prior the economical release comes out, you are within those 2 hours. I personally don't take any trade. You can do whatever you want, guys. My advice is to not take any trade within the 2 hours prior to the news. Okay, just wait. If there is a new, if you get a signal and it's within the 2 hours, just wait. Let the news come out. Let it do the spike. Okay, and once it's gone. Okay, once you've put the news on your back, then start reanalyze the scenario and see if the entry is still possible. If not, well, no worries, you let that one go. There are many opportunities coming in the market every day. You don't have to take them all. Okay, remember, it's trading is not about how many times you win, it's about how many times you lose. Okay, if you cut your losses small, or if you try to avoid losing as much as possible, not overexposing yourself in situations you shouldn't be in the market, sooner or later you will make money. Alright, and the second rule is to not enter a trade at least or let's say 30 minutes. I personally do 30 minutes after the news comes out. I basically, when you need to wait some time. 30 minutes should be enough for the dust to settle. Okay, after the news comes out, like I said, there is some random spikes on the chart, and then it takes a little bit of time for the dust to settle before price begins moving it's the way it's supposed to. Okay, so here is the news. Let's say 2 hours before that, it's a no-go. 30 minutes after the news, it's a no-go either. Okay, after 30 minutes, you are good to go. Prior 2 hours from the news, you are good to go. But as soon as the news come out, okay, 5 minutes before, move a stop to break even, or if you are still -5, -10 pips, exit. Just take the small loss, and in 5, 10, 15 pips is nothing. Okay, you can make that up in the next trade. But -40, imagine the spike goes against you and you are -40, that's a big loss. Okay, it's better to take a small loss and to make it up in the next trade than to try to, well, than to expose yourself to a larger loss. Okay, so 2 hours prior the news, no trade, and no trade after 30 minutes after the trade. Okay, now let's go back to the Forex Factory calendar right there. So we know that at 1 p.m. we are not supposed to be in the market unless the stop is moved to break even on the Canadian dollar currency pair, which was the Euro Canadian dollar. We are not to take any trade from 11 a.m. onwards until half past 1 p.m. Okay, now next one up, we were also monitoring a trade on the Australian dollar against the American dollar. Well, if we go to the Forex Factory calendar again, we see that we have at 2:30 p.m. we have 2 major announcements coming out. One is the retail sales, and the other one is the producers' inflation data. Okay, inflation data, both of them labeled as high volatility announcements. So 2:30, okay, another dangerous time in the day. Again, we don't want to be in the market from 12:30 p.m. to 3 p.m. on that particular currency pair, this one, the Australian US dollar. Of course you can enter this one, okay, at 2:30, or whatever happens in the Australian dollar or the American dollar should not affect what happens in the euro against the Canadian dollar. Okay, so you are good to trade at 2:30 in this currency pair. Okay, this one is a go, but this one is a no-go. All right, because it's related to the American dollar, and there are 2 economical releases coming out from America at that time. Okay, so it was 2:30, so that means that from 12:30 to from 12:30 we cannot take, or I personally don't take any trade. 2:30 is the news, so let's give it 30 more minutes to for the dust to settle. So that means that at 3 p.m. from 12:30 to 3 p.m. We don't want to be in this currency pair, in any position open in this currency pair, unless our stop is to move to break even prior the news. Okay, guys, that was all. It's as simple as that. Don't expose yourself to some chaotic spikes on the chart. I mean, what's the point in very carefully selecting your pairs? What's the point in making sure that you have all the moving averages on your side, all pointing in the same direction, all parallel to each other, the 100 moving average not ever being not being challenged, blah 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 blah. If we enter right when a massive announcement is about to come, and any spike could take us out by chance, without it's out of our hands. Okay, so there is no point in being very careful about all the other aspects of the homework prior to the trading session. If then we mess it up entering a trade half an hour before the news are hitting the wires. Okay, there is no point in that. Okay, we want to be consequent. We know that there is some high volatility coming ahead. It's best to stay out. Okay, give it at least 2 hours, like I say. All right. Okay, guys, that's all for this video. Any doubts, any questions, please feel free to send an email. Bye bye.
Hi folks, this is Hector. Welcome to a new video of my Forex trading course. In this video I want to be talking about trade plans, what a trade plan actually is, how you go about developing your own trade plans, what elements should you take into consideration when it comes to develop your own trade plans for your own trading setups, etc, etc, okay? For that, what I'm gonna do is I'm gonna record 2 setups, okay, or actually 2 trade plans for 2 setups that I'm looking to trade myself today. What you're watching right now is my live screen. I'm gonna be showing you 2 setups that, like I say, I am looking to trade myself on my own account. I thought it would be a good idea. You will get a clearer picture. If you saw 2 real examples, okay, of 2 of my trade plans, rather than if I just lay out the theory, alright? So I'm gonna be showing you, like I say, 2 of them. The first one is the euro against the Canadian dollar on the 4 hours time frame. Okay, which is the chart you're looking into right now, and well, let's get going. All right. Every trade plan should have or should check different elements. Okay. The first of all, of course, is always the trend. Am I trading? Are we trending? Okay, or are we moving sideways? Am I looking into an uptrend, and therefore do I want to search for long entries, perhaps a downtrend for short entries, or perhaps there is no trend at all, or there is a trend but it's not strong enough. Some of the 3 element conditions that I laid out on the first chapter, on the first video of this chapter, are being violated, or they just don't apply, etc, etc. Okay, first of all, have a look at those moving averages, have a look at the trend. Is it a nice trend? Is it the trend you want to get involved with? Well, in this case, I reckon it's a pretty nice trend. I mean, all the moving averages pointing up, price spending most of the time on the right side of the 50 simple moving average, which is this one in red. Price nowhere near the 100, etc, etc. Okay, so. Yeah, it's a pretty nice trend. Okay, I reckon this is a trend I could try it. Second element: is there any news announcement coming out today? Okay, any news announcement involving the euro or the Canadian dollar? Remember that we are looking to try the euro against the Canadian dollar. Okay, so. I want to have a look into my economical calendar and see whether there is any news, I mean, any important, significant news coming from either Europe or Canada. I've already checked my economical calendar. There is nothing really important coming out today on either those 2 currencies. So, you know, I'm pretty safe that I will not be surprised by any crazy random price spike out of the blue, okay, due to the news. All right. All right, we've put that out of the way. Another element you always want to have a look at or into, as I explained before, is the longer time frames. What are the longer time frames? What do they look like? Okay, in order to do that, what I do is I quickly have a look into my daily chart. Well, nothing really here. The previous low was broken. We're making higher highs. Okay, sorry, higher lows, higher highs. So far so good, we are in an uptrend. Let's now have a look into the weekly chart. Pretty much the same. The following, I mean, the next resistance level is right there, but it's way too far above. It's like well, 500 pips above. There's plenty of space to squeeze some profits here. So, you know, no really, this previous level of resistance was broken already. This one, the one that I showed you on the daily chart, also got broken to the upside. So as far as the longer time frames, I see no particular contradictory signal, okay? No conflicting signal on the longer time frames. So that's all right. Another you know, we have the green lights as far as the daily and the weekly chart goes. Okay, next up, do I see any pattern that I recognize, any price pattern? Well, I don't want to get too much into price patterns. I explain all about price patterns on the chapter number 2 of this forex course. However, for the sake of you know, accuracy, yes, I do. Yes, I do see a pattern that I recognize. Okay, it's a range, sideways range, which is marked in blue in my screen, effectively formed by this double top and this double bottom. Well, that's. But like I say, I don't want to get too much into price patterns or how to try them. Okay, how to, first of all, how to recognize them, and second, how to, you know, find a possible trading opportunity in of those price patterns. In this case, I do see a price pattern. Okay, and I know what to do when I see these type of formations, because, well, like I say, I explain all about it on chapter number 2. What I will say nonetheless is that always when I see a congestion area at the end of the day, sideways price action, okay, horizontal price action in an uptrend, the way I personally trade it is only if the breakout takes place to the upside. Okay, if the congestion area breaks out against the trend, I will not consider that to trade that breakout. Okay, but like I say, I don't want to get too much into that. I will let you guys deep you know, dig as deep as you want into price patterns on the chapter number 2. Second, another element you want to always keep an eye on is where are my levels of support and resistance. All right. Well, my levels of support and resistance, significant support and resistance, of course, first of all, is this double bottom I was talking about. In this case, it's a 150-50 round number. All right. That's the key level. If this level breaks, you know, to the downside, probably this uptrend will be compromised. Okay, I don't want this level to give way in this uptrend. If I see that price is breaking to the downside, I'm violating therefore this support level, I will consider that you know, for the time being, I might this uptrend might be in weakening. Okay, moreover, we have a clear uptrend. Actually, let me draw that properly. There we are. Okay, that's an uptrend line. Very rather clear uptrend line, which comes actually at the same level of this double bottom I was just talking about. All right, that means that, well, you know, by any means, if the 150-50 breaks to the downside, I just don't want to get involved with this setup anymore, and therefore, you know, my trade plan is to not get involved if this level gives way. Okay. Once again, the 150-50, this level breaks, then my trade plan is violated, and therefore I don't want to get involved with this trade no longer. All right. Another element you always want to consider, or you always want to write down on your trade plan for the day, at least as far as this setup goes. What type of price action do I want to see in order to consider getting involved with this market? Well, I just mentioned it. I want to see a breakout to the upside. Moreover, I don't want to see just a normal breakout. I want to see a special, a very particular pattern that I like to trade when it comes to trading sideways ranges. Okay. or rather the breakout of those sideways moving ranges. But anyway, like I said, I don't want to get into that. That's all explained in detail in chapter number 2. However, what I want to see is a breakout to the upside. I just mentioned that any other type of breakout, or either if price continues moving sideways within those two boundaries, or whether the breakout takes place to the downside, the trade plan will be considered violated, and therefore, I will not be looking to trade the Euro CAD on the 4 hours time frame no longer. Okay, only if I see a breakout to the upside right there above the 152.00 level, I will actually be looking to push the buy button. Okay. All right. Another element every trade plan should have, into consideration is where will I place my stop loss and where will I place my target, my price targets. Okay. I talk all about stop losses and price targets on chapter number 4. Therefore, I don't want to overload you with the information. I just want you guys to remember that when it comes to before you actually pull the trigger, you must know where you will exit the trade, okay, or at what level you are looking to bail out of the trade, both if it goes wrong, and therefore we're talking about your stop loss level, and both if hopefully it goes in your direction, and therefore we are talking about your price targets. Also, you want to already know before pulling the trigger, like I say, whether you're going to be exiting all the position at once, or whether you are going to be exiting in 2 levels. As I explained, like I said in chapter number 4, on occasions I set a two-step exits. Okay, I take half of my position at one level, and then I bank half of my lot size at that level, and I let the second half of the trade, the second portion of the trade, run to a second target placed farther up. All right. So you always want to know where will you place your stop loss level, where will you place your first target, if there is any first target, and where will you place your final target. Okay. Like I said, I don't want to overload you with information. You guys will receive plenty of info about stop loss levels and price targets on chapter number 4. And finally, the time scope of this trade. Okay. How long do I expect, or do I want to have this trade open? Is it an intraday trade? Am I trading a trade? Trading an intraday trade, meaning a trade based on, I don't know, the 30-minute time frame, the 1 hour time frame? Perhaps am I scalping off the 15 minutes or the 5-minute chart? Or perhaps am I taking a long-term entry of the daily, weekly, God, even monthly charts? I don't trade the monthly charts. It's just way too long for me. I don't feel comfortable trading such a long time frames. But anyway, I reckon some people do. And you always want to know how long, just as you want to consider your price exits, okay, both the targets and your stop losses, you want to always keep in mind a possible time exit, okay? For example, if you're trading if you're considering an intraday trade, and by the time your trading session, by the time the day has come to an end, you don't see price moving in your direction, your targets have not been met, or even price, it's basically moving nowhere, it's basically it's just not taking in your direction, you may want to manually close your trade. Why? Well, quite frankly, because you may be riding a momentumless swing. Okay, you always wanna keep in mind that if you are taking, for example, an intraday trade, that means that you should enter and exit the trade within 24 hours. Okay, within the trading day or within your trading shift. Okay. An intraday trade that by the end of the day has not quite either showed, a profit or a loss, or it's just going nowhere. Okay, let's say you take an entry and 6 hours later is still sitting at plus 10 pips, okay, or plus 15 or 5 pips, something that's not really significant compared to how long the trade has been open for. That means that you probably mistimed your entry, or the market has just lost momentum, there is no gas left on that setup, and perhaps you might want to be thinking to manually close your trade. In this case, this is a 4 hours time frame, all right, a 4 hours time frame setup. And therefore I'm gonna be looking to possibly stay about 24 hours within 1 and 2 days on this trade. Okay, no more than that. I don't want to keep this trade open for more than 2 days than 48 hours. If it if it stretches out beyond the 48 hours time limit, I will have to reassess the situation, because like I say, perhaps I have either mistimed my entry, or the uptrend, this uptrend that you are seeing right now just doesn't have the any more gas left. Okay, so always keep in mind how long you want to keep your trade on. If you're trading off the daily, perhaps you may expect to keep your trade open for a few days, 1 week, okay, perhaps 10 days, no more than 10 days. You don't want to stretch your trade for more than 10 days, okay. If you are trading off the weekly chart, you may consider a reasonable time span would be probably 1 to 3 weeks, 1 month maximum. You don't want to be positioned in that trade more than a month, okay? And conversely, if you're taking a trade off the 5-minute chart, if it's a scalping, scalp type of trade, aiming to squeeze, I don't know, let's say 15, 20, 30 pips maximum, that should be reached within 2 hours, no more than that, okay? 2 hours, as if you've timed up your entry properly, should be more than enough to as a time scope for a scalping type of trade, okay? More than that, I would be considering, like I say, reassessing the situation, okay? So, to wrap it up a little bit very quickly, you want to keep an eye on, you want to take note of the trend, whether there is any news announcement for the day, what's going on the longer time frames, is there any price pattern I recognize, where are my levels, my key levels of support and resistance. In this case, I already mentioned that these were my levels of support, and the 150.50, and these were my level, that was my level of resistance, the 152 down below. Those are the levels I want to keep an eye on, both for a possible breakout in direction of the main trend in order to search for entries, or if it goes against and it breaks my main level of support, both that level and this uptrend, well, the setup is valid no longer, and therefore I will cancel it. Moreover, you want to write down a small script of action you want price to, the type of price action you want to see on your chart in order to search for an entry. In this case, we already mentioned that you want to see a breakout to the upside. Where will you place your stop loss levels, okay, and your targets, and furthermore, whether it will be only just one target, or perhaps you will exit in 2 steps, okay. And finally, the time scope. How long do you expect this trade, or how long should this trade be open for, okay? And what's the time limit you may begin to, to want to consider to reassess the situation, perhaps manually close the trade, etc., etc. All right, that's the trade plan for the euro against the Canadian dollar. Now I'm going to show you the other setup that And following today, it's a possible short entry intraday type of trade. At the end of the day, this is the 30 minutes chart. It's a setup based on the 30 minutes chart on the USD against the JPY, meaning the American dollar against the Japanese yen on the 30 minutes time frame. Like I say, anything that's taken or is based on the 30 minutes time frame, in my opinion, is considered an intraday type of trade. So first of all, as usual, where is my trend? Is there actually any trend in place? Well, yeah, there is a trend. All right, have a look at that trend. We do have a little bit of a crossover there for 1 minute, okay, for 1 second really. Oh, actually not for 1 second, it was for a few hours, but nonetheless, very briefly, a little bit of a crossover, but straight away it came back down in place. And also it's worth noting that at no time price violated the dynamic area of resistance. Okay, this is the dynamic area of resistance, the area I'm marking right now on my screen, and as you can see, it's been holding price below at every swing. Okay, so despite the fact of, you know, that we do indeed see this small crossover there, I'm not overly concerned about it. Moreover, you know, price is nowhere near the 100 moving average. All of them are pointing down, okay, in the same direction, parallel to each other, etc., etc. Like I said, the only little, you know, glitch on this trade would be that small crossover, but it's not a big deal. Okay, at no time the dynamic area of resistance has been violated. Okay. So yeah, first element of any trade plan, the trend is in place. I am fairly happy with this trend. I can, you know, say I'm fairly happy with this trend. I can, you know, safely search for short entries. Okay. Then news announcement. Is there any news announcement coming, either the American dollar or the JPY for today? Yes, there is. Actually, there are some news. The inflation data coming today in about 2 hours. The inflation data coming from America, you know, and that will, of course, have an impact on the American dollar. And I know that when it comes to, you know, as we near that deadline, like I say, in 2 hours time, in 2 hours time, I don't want to be searching for entries at that precise time. If I see that I might be getting an entry at that precise time, I might pass. Okay, I might pass on the signal until, you know, the news are out of the way, until the dust settles down a little bit. And once the news are out of the way, I will continue on searching for an entry on this setup. All right, I've made a brief note about that news announcement coming out from America in 2 hours time. I want to always keep in mind that, so I don't get surprised by, like I was saying before, any, you know, random crazy spike on the chart that might knock out my stop loss within the second. Okay. Furthermore, what about the longer time frames? Well, let's have a look at the 4 hours time frame. Nothing there. Let's have a look at the 1 hour time frame. Daily time frame. Sorry. Well, the previous level of support, it was that level, got broken really. So the downtrend continues. Now, well, let's have a look at the weekly chart. Nothing really. I'm scrolling back for the last 1 year worth of price action. There is nothing there. All those levels of support, okay, all these levels of support have been broken to the downside. The trend is still in place. All right, you know, it's fairly safe to search for short entries. So, you know, I've checked the longer time frames. I know there is nothing, no conflicting signals on them. So, you know, that's another plus, you know, another tick on the list. Okay, any price pattern I recognize? Well, yeah, there is. It's a pretty prototypical swinging formation. I explain all about swinging formations on chapter number 3 of this trading course. So I don't want to, like I was saying before, I don't want to upload too much information. You guys just have a look at the chapter number 3, and you will get plenty of information as of how I tried this type of swinging. Have a look at that swinging price action. All right. Where are my key levels of support and resistance? Well, the key level, I've marked it in blue already. That's the key level of resistance above, okay? Right above us, around the 106.50. Moreover, we have the dynamic area of resistance coming around that level as well. So that's the key level to keep an eye on, okay, on this trend, at least for today. I always say it's very important to always keep in mind what's the key level to keep an eye on, okay, for the day, in order to determine whether the trade plan is violated or not. And that's to always draw the main level of support and resistance, and as long as that level is not breached, we are still in a trending scenario. The trend and the trend and the trade plan are both still intact, okay? They are still strong, and we still have the green lights to search for trades. In this case, like I'm saying, is the 106.50, 106.60 to be exact. If price reaches above that level, if we break above that level, not only we break above yesterday's low, okay? Moreover, we break above the dynamic area of resistance, and therefore we would be, the 100 moving average would come around that level, and we would be nearing that 100 moving average, which, as you guys know, it's a big signal of weakness. As far as I am concerned, as far as my system goes, it's the signal of warning, of weakness in any trend. Okay, you want to stay away from the 100. Want to stay away from the 100, as much as possible. You want the dynamic area of resistance to hold price on the right side of the market, in this case meaning down, meaning below, sorry. If that level, the 106.50, 106.60, okay, this level, that's my key level of resistance, breaks, if price breaks above, it might be a signal of weakness in this downtrend, and perhaps you might want to consider the trade plan violated, and therefore, you might want to pass on this setup, okay? Fine, now we know where the key level, the key support and resistance level for the day is, as we already mentioned, 106.50, 106.60. Moreover, what type of price action I want to see in order to consider an entry? Since we are looking into a swinging type of price action, what I want to see is a little bit of a retrace back, okay, to the dynamic area of support and resistance, okay? As you guys know, in a trending scenario, I always like to base my trades off that area. In my opinion, is the optimum area to join the trend, okay, to jump into this trend. And for the time being, right now, we're a little bit too far below. Okay, we're about 50 pips below the dynamic area. It's a little bit too far away, in my opinion. I don't want to enter trades that far away from that area. In this downtrend, okay, the perfect area to enter the trade, to rejoin this downtrend would have been, as you can see, around the dynamic area of resistance as usual, okay? It's always the optimum, as long as it's holding, okay? As long as it's holding price on the right side of the market, in this case, to the downside, of course, since we're in a downtrend, you always want to search for entries around that area, okay? Like I say, as far as my system goes, is the dynamic area of resistance is the optimum level to search for an entry. Right now, like I'm saying, we are a little bit too far down below the dynamic area. The dynamic area is up here around 106.50, whereas current market price is 106.11. It's about 40 pips away. I'd like to see price to retrace a little bit closer to that level. So the type of price action I'd like to see, like I say, is having seen this downswing completed, then a pullback and search for entries around here. Like I say, I don't want to get into the actual entries. That's explained on chapter number 3. But anyway. Just as we saw, a nice swing down and then a pullback in this case, another swing down, another pullback, another swing down and another pullback. Well, I want to see the same thing, all right? If it worked here and here and here, at the end of the day, technical analysis is nothing but, as I always say, analyzing the past, try to see recurrent price patterns, okay, recurrent events, and try to reproduce those events in the future in order to profit from a similar outcome as we actually did in the past, okay? So if we've been swinging down very harmonically throughout the last few days, I'm basically looking to trade the same type of a scenario. I want to see this last swing, okay, this swing I am marking right now on my screen. I want to see it completed. I want to see a healthy pullback to this dynamic area, and around that search for entries as explained on chapter number 3. That's the type of price action, the type of price script, okay, I want to see on my chart before I consider an entry. As usual, also I want to take note of where my stop loss levels will be, okay, where my price targets will be, and also, as I was saying before, will I be exiting at once, okay, the whole lot size at once, or will I split my exits in two, okay? That's explained, as I was saying, on chapter number 4, but it's always important to keep an eye at what levels I want to exit this trade. And finally, as I was mentioning previously, what's the time scope for this trade, for this setup? If I eventually do get an entry, well, since this is a setup based on the 30-minute time frame, it's an intraday type of trade. I expect my entry and my price targets or my stop loss, if things that don't quite go as expected, I expect them to be reached within the day, okay? Within the next 12 within the next 12 hours, okay? If I was taking a trade of the 1 hour time frame, I would stretch it out perhaps to 24 hours. Since this is a 30-minute time frame, I reckon that 5, 6, 8 hours, 10 hours, no more than that, it should be enough to reach a sensible target, okay? If this trade remains open after 12 hours and not either the stop loss or the price targets have been met, perhaps it will be a clear signal that something is just not quite going as expected, something is not quite right, and, I might just want to exit out, lock out as many pips as I possibly can at that time, or perhaps just exit out at small loss. Let's say I am minus 10 pips, minus 15 pips. Oh well, that's trading. If this trade, once I get an entry, if it remains open for, like I say, 8, 10, 12 hours, more than that, perhaps it would be a good idea, it would be a wise trading decision to close out the trade, even if it's, like I say, at a small loss, in order to avoid a possible larger loss, okay? Or simply move a stop to break even. If you are already in profits, even if it's just 10, 15 pips, just move stop to break even, and that's about it. That's a whole lot of stress off your mind, okay? Okay, guys, recapping a little bit on this setup. First element of this trade plan, the trend. I have a clear down trend. I want to be searching for short entries. Good. What about news announcements? Yes, I know there is a news announcement coming out in about 1 hour and 40 minutes from here, and I want to keep an eye on that. I am aware that we have news coming out at that level, at that time, of the day, and if I get an entry around that time of the day, like I say, I may want to not take that entry, okay? The worst thing that can happen is to take an entry, 15 minutes later, 30 minutes later, the news come out, they spike price to the upside, and knock out your stop loss within the minute. You don't want that, okay? You certainly don't want that. That's very frustrating. So, always important to keep an eye on the economical calendar for the day. What about the longer time frames? We've already determined that there is no conflicting signals at all. Everything looks all right on the daily, on the 4 hours, on the even the weekly chart. You know, no levels of significant support or resistance right ahead of our position. Do I recognize any type of price pattern that I usually try? Yeah, as I was saying, I recognize the swinging type of pattern, which is explained on chapter number 3. What about my the key levels of support on resistance for the day? I've already determined what's the key level for the day. The 10650, 10660 with the yesterday's low. Okay, actually it's a double bottom, right? I hope you guys can see this double bottom effectively forming like I say, the key level for the day, and also we have the dynamic area around that level. Should this level should price break above that level, the whole setup will be compromised, the whole trend will, weaken down, and therefore I may want to not take this trade anymore. What about the script? What about the price action I want to see? Well, we've already determined that what we want is to see this whole swing to be completed, see a little bit of a pullback, and search for entries around this level. Okay, search for short entries in order to exploit the next swing down. Okay, that's explained on chapter number 3, guys. Don't worry about it. Finally, what are my where will I place my stop loss? Where will I place my stop loss? Where will I place my my profit targets? And what's the time scope I want to set for this trade in order to to possibly manually close a trade in case either my stop loss or my target price have not been reached by the time the I reach the time scope deadline. Okay. Well, guys, that's basically all as far as trade plan goes. Like I say, it's a trade plan is nothing but writing down all the conditions you want to see on your chart before pulling the trigger. It's important to have all those things lining up, okay, all the ducks lining up in line before actually pulling the trigger. Once you've pulled the trigger, once you are in a position, you're in control of the situation no longer, okay? Then it's up to the market to determine whether you will be given a profit or a loss, okay? As far as a trader goes, as your point of view as a trader goes, what you can control is up to the point when you press the buy or sell button. Okay, up to that level, you are still in control. Okay, you can decide whether you want to get involved or you want to sit out of that trade. Okay, up to that level, you are in control. Beyond that level, it's up to the market to decide, like I say, whether your trade is going to take some pips off your account or well, grant you with some pips, okay, with a reward for a work well done. So what you want to do is up to that moment, when you press the button, you want to make sure that you have all the different elements covered, okay, that you've taken into consideration, all the different elements, all the different important elements of the equation. So once you press the button, you know as a fact that you have the chances leaning on your side, okay, that you have the odds on your side. And well, if finally you score a loss, so be it. That's trading, you know, there is nothing certain in trading, but at least you knew that you did your job, okay? You had a 60, a 70, perhaps an 80% on that setup to score a winning trade. And well, beyond that point, you know, it's not really up to you. What you want to do is up to that point to make sure you have everything under control. As much as you possibly can, okay? That's why you want to list out all those different points, all those different characteristics, elements I've been listing out for you on this video. Make sure all of them are ticked, okay? Make sure you have the green lights on all of them. So like I said, once you press the buy or sell button, you can sit back, relax, and know that at least as far as you are concerned as a trader, you've taken you've taken in consideration all the possible elements to make sure that the chances are on your side. All right, folks, that's all for this video. As usual, if there is something you quite didn't understand about trade plans or about how to implement your trade plan, please don't hesitate to send me an email, okay? Trade plans are extremely important, okay? It's extremely important to realize when your trade plan has been violated and therefore you don't want to get involved in that setup anymore, okay? In order to cut down on possible losses before, like I say, before you actually pull the trigger, all right? So trade plans are crucial, guys. Every professional trader, believes me, writes down a different trade plan for every different time, for every different trading setup, okay, for every different trade they are looking to take, and they make sure all the key elements, like I say, are being ticked before actually entering the trade. But as I was saying before, if you have any doubt, if there is anything you didn't quite understand, feel free to send me an email, okay? I will very gladly assist you as much as I possibly can, alright? Okay, folks, I'll be seeing you in the next video. Bye-bye.